The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Now, the evolving policy situation in the U.S. will take center stage this year amid continued rate cuts from key central banks, including the U.S. Federal Reserve. So does this provide a case for U.S. equities to strive, or the other way around? What asset classes should investors take note of as inflationary pressures continue to rock markets? What would a perfect asset allocation look like? Well, to find out more, joining me now is Luke Browne, who is the head of Asset Allocation of Asia at Manulife Investment Management. Luke, welcome to the show.
Good afternoon. Thank you very much for having me.
Thank you so much for joining us. Luke, the new U.S. administration and a pause on rate cuts from the U.S. Federal Reserve have, characterized the first month of 2025. Now, with the U.S. marching ahead with new trade policies here, can we see a further rise in inflation?
Well, look, I think there's quite a lot to unpick here. And in your opening remarks, obviously this is quite expansive, but if we try and digest it into bite-sized pieces. So let's first of all start off with what we've seen from the new administration. Clearly, Trump has announced some policies in terms of immigration, in terms of tariffs. Now, what that's meant to start off with for the Federal Reserve, they're looking at the data. They have a very clear objective, and they're looking to control inflation. Right. So I think we put tariffs to one side for a second and look at the resilience and strength of the U.S. economy. The market has adjusted expectations. Potential rate cuts have been moved further out. Our base case is that we're likely to see 2 to 3 rate cuts later this year, but we are very data dependent. Now, if you look at the feedback that the Fed gave after the last meeting, it's clear, at least to me, that they are very much on hold. They want to see further developments. And the only thing that I would say about that is that economic data, when it starts to move, can lag what's actually happening in the real economy. So there is the potential, it's not a base case, but there is the potential that towards the end of this year, we might be looking at more aggressive and deeper cuts than the market is currently anticipating.
I see. Well, inflationary pressures continue to rock markets here. But how might this, some people are calling it the Trump reflation. How might this create more turbulence in markets? Are we witnessing the turbulence already?
Yeah, look, I think we are. And there's one thing about markets, and what we don't like as investors is uncertainty.
Right.
And, let's look at what's actually happening here. So Donald Trump is talking a lot about tariffs, imposing them globally, frankly, across all trading partners. Now, tariffs, conventional wisdom will tell you that that is inflationary because ultimately it's the end consumers that are going to pay. Now, you marry that with the policies on immigration. If there are 5 million illegals that are going to leave the country, well, that's going to put huge pressure on already strong employment data in the US, rise, therefore, in salaries, which again is potentially inflationary. So, those are inputs. What I would say, however, about the tariff situation, let's just look at what's happened overnight. Okay, we're all waiting for the 2nd of April.
Right.
But the way I'm talking to clients about it is saying there is form and there is substance. The form is Donald Trump and the administration come out talking about large-scale universal tariffs. The substance is the detail that we subsequently get. And we've already seen, as I say, in the last 24 hours, something of a pullback from the initial statements.
Right. So let's take a look at, the perspective of an investor. So given the economic outlook and the potential for upward pressure on inflation, should we still remain optimistic about investing in equities?
Well, look, I think global equities, yes, and it's certainly our view and how we're positioning portfolios. We do have an overweight stance. Now, you then need to start to look a little bit deeper. Which equities do you want to be invested in? The US markets dominated 2024. We have seen a retracement there, and there have been better opportunities elsewhere in the world. China up 30% this year. Europe performed particularly strongly. And of course, we've seen a correction in the US. But one has to be nimble. The US correction, I think, we're viewing as roundly healthy. Technical levels have held, and it's given us opportunities to redeploy capital. But equities, yes, but look at the broad spectrum of opportunity.
All right. Well, with the S&P 500 surge of 23.31% in 2024, as you mentioned, U.S. equities had a great run in 2024. What factors do you think will keep U.S. equities strong in 2025 despite global economic pressures?
Well, it depends on which commentators you look at, and there's lots of data to cut through.
Right.
I hear comments such as US equities can be characterized as over-owned, overbought, overvalued. There is some truth to that. However, there is good reason for that. If you look at the innovation that you're seeing in US stocks, and that's been characterized by AI, by the Magnificent Seven, etc. These are global leaders. They have the ability to continue to surprise on earnings. So given the correction we've just had, not only in value terms of the S&P around 10%, but also in the time value.
Right.
This has gone on for 3 months now. This is a pause. It's an opportunity to start catching up and reflect on what the markets can do. Now, all of this is predicated that the US is going to continue being resilient, that we're going to see soft landing, if you wish to call it that. And that's certainly something which I would subscribe to.
Right.
The caution I would give for US markets is there is some underlying fragility that you can see, whether it's through SMEs, whether it is through some defaults that you're starting to see in smaller companies, not large in dollar terms, but large in number terms. And these are the kind of things that you need to look at to understand whether or not, there remains the impetus for these outsized growths. I don't think you're going to see another 25% return here from US equities. And as I say, opportunities do present themselves elsewhere.
Well, would you say that the U.S. equities be better in one's portfolio than, say, other developed markets?
Well, at the moment, as I say, we sort of trimmed our US equity exposure towards the end of last year and into the start of this year when we start to see corrections. But also, as better opportunities emerged, we have pivoted some of our allocations towards Asia, China and Hong Kong equities in particular, and also into Europe. Now, ironically, you're now in a situation where Europe has performed well. A lot of people are starting to talk about it. It's become somewhat consensus. We're actually taking some chips off the table there. It's come a long way very quickly. There are still structural challenges. Yes, the ECB is somewhat ahead of other markets or other central banks because they started their cutting process, but we just want to see how the data evolves. PMIs are particularly soft. So, yes, there's optimism there, but for the moment, we're kind of sitting on the sidelines. So, US is attractive for what it's done, and, then you can look through the different sectors.
I see.
Financials have been a particular outperform, and I think they can continue. Healthcare. And certainly if you can be select about which elements of healthcare you want to allocate to, which I personally believe is a long-term secular theme.
I see. Well, with major economies like Canada, the UK, and Europe experiencing weak growth here, how do you see these economic conditions affecting global market performance, particularly in the context of rising borrowing costs? Yeah,
look, borrowing is one that we discuss at length. And, you have a number of major economies, and you've cited 3 of them there, where debt to GDP ratios are 100% plus. Now, interestingly, we've seen something in the EU, the sort of re-defense, if you like, of NATO, based on some of the comments from Donald Trump and obviously what's happening with Russia-Ukraine. Now, Germany, who has exercised fiscal constraint for longer than I've been alive, they're in a fortunate position in some ways where their debt to GDP is something like 67%. So they do have the ability to release the taps. Where it's more complex is in the broad EU context because, of course, the EU is not a solidified fiscal arrangement.
Right.
And, you need to look at the north-south divide. Obviously, Italy has much higher debt to GDP ratios. Now, when you tie all this together, not only is the debt that you need to be concerned about and the debt servicing, it's those reflationary pressures that we talked about where central banks might not ease as quickly as possible. A case in point is what you're seeing in the UK at the moment, where the OBR is coming out and adjusting their growth expectations, debt financing costs, and Rachel Reeves, the Chancellor, has a delicate balancing act to meet her fiscal rules because of these evolving conditions. Growth is anemic and something needs to be done to stimulate it. Again, however, you can sort of look through this and say, well, there are opportunities where you can allocate. The reflationary pressures are there and there is concern, but they're not dominating discussions at the moment. A little bit of settling down, things could work out. watch deglobalization. A lot of this was from COVID.
Right.
A lot of countries recognized that supply chains were causing myriad knock-on effects. So the idea of nearshoring or friendshoring is clearly back on the table. And I think, that's something that's going to emerge over the medium term. This is not something in 6 months. You can't rebuild manufacturing or local supply chains just by flipping a switch. But, you need to look at the intent and the progress that takes place there.
I see. Well, then what specific risks do dollar-dependent emerging markets face as the Fed may slow its pace of rate cuts this year?
Yeah, it's an interesting one. I mean, if you look at the performance of the US dollar and obviously DXY against a basket of currencies, it's come off several percent so far this year. Now, I see no reason why there would be a capitulation in the US dollar, in particular with the Fed now, kicking the can down the road somewhat in terms of their rate cuts. Now, those countries that are dependent on dollars either for trade or for financing, we need to be mindful of their ability to meet potentially higher funding costs.
Right.
You also need to couple into that, I think, commodities and those more commodity-sensitive countries, particularly in the Asian markets. And then also how does this also fit into the great AI and big data and big tech revolution? Who are the winners and who are the losers?
I see. Well, what about in terms of fixed income here? How might the current economic landscape not bode well with fixed income markets?
Well, there's a few things here. And I think, the starting point is to look at government debt.
Okay.
And one of the things that I believe, and, we have seen a lot of this already, is what you might call normalization of the term structure, i.e. we've gone from negative on a forward basis into a steepening of the curve. Now, with the amount of debt, it's perfectly possible that you are going to continue to see term premium expansion. Okay, so steeper yield curves. If you look into Europe, look what's happened to France recently. Okay, so you've got the government piece there to consider. Then if you start looking into the corporate world, if you look at US high yield, US investment grade, arguably priced to perfection. Okay, but similarly, there are other places you can look where I think you get arguably a superior return for the amount of risk you're taking on. Asia high yield on an apples to apples comparison with the US. In places, it offers superior spread-adjusted returns. But my guidance to people here, if you look at Asian high yield, many of the sort of beta or passive or index-based solutions, by construction, have a dominant weight into China and property. We prefer to work with active managers, including the active managers at Manulife, to benefit from bottom-up security selection.
I see.
The other place that we do like and we are allocating to is emerging market debt.
Okay. Well, speaking of inflation here as well, the Fed's preferred measure of inflation has consistently remained below 3%, although still not near the Fed's 2% target here. In fact, inflation trend seems to be showing a resemblance to the 1970s. What should investors learn from that period then, and how can those insights inform current investment strategies?
Yeah, I think for this one, we have to look at the old adage, and I'll probably get it wrong. History doesn't repeat itself, but it can rhyme. So, if we look at the factors that influenced the 70s, it was a very different environment. There wasn't the debt burden. We haven't just gone through zero interest rate policy in such loose monetary conditions. Equally, the globalization that we've experienced, which has characterized 2 decades of disinflation, that is starting to unwind a bit. Where I do think there will be lessons that will be learned and applied is that you can't take your eye off the inflation challenge.
Right.
You do not want embeddedness. Part of the issue here and what the Fed are talking about is inflation expectations. All central banks are desperate to avoid consumers getting an embedded sense of inflationary pressure. When that happens, it's very difficult to unpick, and in many cases, you're really looking to disinflate economies by even more penal or restrictive monetary measures and indeed going into fiscal measures.
I see. Well, with inflationary pressures mounting, then how do you see real assets like commodities, real estate, and infrastructure performing in the current market?
Yeah, it's a place that, we're very keen and we have been allocating to. Now, broad-based commodities, I think is probably too far. Oil, not least because of the energy transition and changes in the dynamics of supply and demand is an interesting place. Gold within the commodity spectrum has performed incredibly well, over 3,000 near all-times high. Now, we have benefited from that, and it's been a trade in many portfolios. Again, rotating how much risk we want in that position, and potentially more to go. One to look at might be copper.
Okay.
We have a very in-depth research framework, and we have dedicated research hubs. And, we go through our framework, which is to look at macro, fundamental, sentiments and technicals, and then also with the ESG componentry. Now, copper has come up in recent discussions. We have already got it as positions in certain portfolios where they're able to. And there is a strong case of, a potential super cycle, not just in copper but other commodities. It's been discussed by a few people over the past few months, but that's one that we could potentially look at.
I see. Well, now sectors such as energy, infrastructure, and real estate investment trusts have, become undervalued here. How can we then position these sectors favorably in our portfolios? How should investors approach these sectors in 2025?
Look, one always needs to be a little bit cautious of just looking, through a single dimension of valuation.
Right.
Don't get caught in value traps. Sometimes things are cheap for a reason. Now, I think in the case, however, of REITs, yes, you're talking at a particular segment that has been unloved. And we can draw comparisons with other markets when that sentiment turns, and there are reasons why REITs could start to recover and outperform, and they have desirable income traits and characteristics, which in Asia, of course, is particularly relevant. So, I would look there. But a particular one that we do like is infrastructure. I think, the very need to rebuild, we've talked about the supply chain issue and, what governments are trying to do in general. I think infrastructure is one that, again, if you're looking at a longer-term secular theme, is one that has the potential to perform well.
I see. Overall, Luke, how do you expect demand for real assets to evolve in the coming years, particularly with rising interest rates and inflation concerns?
Yeah, so real assets, I think, are likely to have an increasingly important place in portfolios. Now, part of that is predicated on the idea that, whilst inflation, I believe, will be controlled and contained, we're moving out of the last decade or more of pretty much zero inflationary pressure and zero interest rates. You are going to see more inflation. There are going to be episodes of elevated but not extreme. I'm not talking about, the 10, 11% we saw 24 months ago. So real assets do offer an opportunity to defend portfolios in those situations and offer real returns. I think, the same is true if you look on the fixed income side and interest rates. Yes, we are going into an easing cycle with the exception of Japan for very good reasons, and that's a positive thing. But, fixed income, we need to get to a point where it's offering a genuine real return, certainly for government bonds. Depending on where you look, you need to go slightly further out of the curve to get a real yield, certainly one that's meaningful.
I see. Well, my last question for you here, Luke, might be a tricky one, but with all of these in mind, what would a perfect asset allocation look like as investors tackle the challenges of today's market landscape?
Well, obviously you just need to look at the Manulife multi-asset funds. But that aside, look, I don't think that there is a concept of a perfect allocation. You need to think about an investor's utility. We try and satisfy investors that are looking for a core portfolio theme, such as income. And we have portfolios that are globally diversified and nimble that allow us to deliver those outcomes persistently. We have other clients who are more concerned about maintaining the value of their money. And, we've talked about the inflationary environment.
Right.
Typically less risk, more fixed income orientated. But equally, we have many clients who are looking for longer-term themes and thematic-orientated portfolios. And, when we start to unpick what are the secular themes that, we need to be cognizant of in portfolio construction, and ones that I might mention, from a country point of view, India and Indian equities. I think that there's a very strong long-term theme there. Energy transition, I think we're all aware of that. I've mentioned healthcare. And, combining those in a way that's impactful for clients. But I think the critical thing for me is that understanding where you want to be active and nimble, how you want to build portfolios. And for me, I firmly believe that combining bottom-up security selection with top-down asset allocation to maximize the probability of delivering a successful outcome is what you want.
I see. Well, thank you so much, Luke, for joining me today.
My pleasure. Thank you for having me.
Thank you. That was Luke Browne, who's the head of Asset Allocation of Asia at Manulife Investment Management. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.